The dollar is plummeting and gold is ripping. Are we going to see $3,500 gold this year? Let's talk about it. Welcome back to the channel, guys. Today we're going to be talking a little bit about the dollar. We'll take a look at gold, and of course we'll dive into the indices and other currencies. As we get started, if you could do me a big favor just to help out with YouTube, hit the thumbs up button. Let's jump in. So the dollar index seems to be retesting its previous low around 103.4. And I want to talk about why this might be happening and whether or not the dollar index is due and perhaps doomed to head back and retest this previous low all the way down at 100. Taking a look at retail sales numbers here for today, you can see that we did miss expectations. Now, what is retail sales and why should it matter to you? Well, retail sales is what it sounds like. It's the consumer going out and buying products and services out there in the economy for the US. And why this matters so much is the state of the consumer, whether they're out there spending or not, plays a huge role in the evolution of the economy. Now, for the strength of the dollar, what would we want to see? Well, we'd want to see this number come in way stronger than forecasts or expectations. Now, analysts and economists forecast this data point. You can see our red dot here, and then we fell short of that data point here today. Now, that is showing us that the retail consumer is pulling back a little bit. And that wobbliness in the consumer is perceived as a bullish thing for gold. Why? Because it's bearish for the dollar, right? If the US economy is slowing a little bit, that acts to support or buoy the price of gold higher as people are saying, okay, weaker dollar, uncertain economic conditions, let's stay with gold. Breaking it down to a 4-hour chart perspective, you can see gold at the time of recording this video is attempting to push higher, and perhaps we just have another bull flag here like we have seen in recent weeks. This has been a really good signal when you get this consolidation and then a break above. Let's see if we can get a similar price pattern emerging here in gold once more. When we take a look at the US economic heat map, what I want you to understand here is that most of our data points for the US dollar, at least the impact here, are looking pretty bearish. Check this out. We added this new kind of filter at the bottom where it takes a look at all of the different metrics and it analyzes the overall economic data impact to the US dollar. With retail sales missing expectations here today, as well as CPI numbers last week coming in soft, showing cooling inflation, a lot of these factors are really piling up some bear cases for the US dollar. By the way, if you want to try out the tool that I'm using here for yourself, there's a link in the description down below. The Edge Finder allows you to track all sorts of economic data, positioning data, institutional positioning, retail positioning, seasonality, and combines it all into a top setups algorithm, giving me my watch list that I use each day as a trader. And I should also mention that this week we're giving away a free copy inside of our free Telegram channel. All you have to do in order to enter for a chance to win a free copy of the Edge Finder this week is step 1, join the Telegram channel, and step 2, follow the instructions that are shared there today. The link can be found in the description below. So as gold attempts a new record high yet again, which by the way, we've put in multiple all-time highs already this year, I think that can continue, especially with the data here pointing to a weaker US dollar. Again, inflation data coming in cool last week. That gives the Fed the ability to cut interest rates more. And one thing that's sort of confirming it, or trying to at least today, is bonds. Bonds are moving higher. I've been long on TLT for some time. I'm looking for a proper breakout here, a breakaway trade to the upside. Let's see if we can go back and test those highs. Now, again, if economic data is cooling and inflation data is cooling, that combination is TLT's sweet spot. And we can combine this concept with bonds with the US dollar, because if you get cooling yields, which is the US government offered yield on bonds, if that's going down, that's the bond market saying, let's be careful here, let's buy bonds, and that's why the yield starts dropping on them. Remember that bond prices and bond yields move inversely to one another. When everybody wants to buy bonds, the yield goes down. When everybody doesn't want bonds or wants to sell them and buy other things, bond yields go up. So with the economy showing some signs of moderating or cooling, we are seeing some demand for bonds come into this market. People are locking in some safety, and I think that's also why we're seeing gold do pretty well here recently. People are locking in safety trades right now and a little bit cautious on the stock market. So let's take a closer look at the dollar index's price action here recently. Clearly, we have seen sellers in complete control of this market and have recently kind of gone sideways on the dollar index. What I'd watch for our next signal of a potential leg lower on the dollar index would be a break and failure below this previous low here on the 4-hour chart around 103.4. Scrolling out again to the daily chart, when we take a look at the dollar index, what I think we could be seeing here now is if you get a failure at this level of support, if that breaks, there's a strong probability, in my opinion, that the dollar index can kind of waterfall now down to its next level at 102. And like I said at the beginning of this video, I would not be surprised if we just blow all the way down to 100 on the dollar index, giving back a lot of our bullishness that we've seen in the last several months. And with that expectation, I continue to stay long and trailing my stop loss on gold. And you can see when I initially took the position inside of our Discord group, I said gold is holding support nicely recently. You can see the initial trade idea that was sent to members. And I also put my stop just below that structure point. My macro data also shows a bit of slowing. Stubborn inflation and stagflation risk equals bullish for gold. But what has actually transpired since I initially took this trade is we got some cool inflation data, which is also bullish for gold, because cooling inflation data plus slowing economic data makes the Fed able to cut interest rates, weakening the dollar, strengthening gold. Now, stagflation is also bullish for gold because, and this is why I think, slowing economic data is just in general is usually a bullish signal for gold, because people want that security that gold offers when stocks and everything else seem to be falling. Moving on briefly from gold, I also like the bullish pullback that we may be seeing in silver. I'm watching for price action to see if we can get a pullback into this 33 level. And if I get the confirmation signals that I'm looking for, then I will definitely be looking for some upside on silver as well. Taking a look at other currencies compared to the US dollar, take a look at the euro. I actually quite like this for a possible either break and retest of this key 1.09 level, continuation plays, or if we do get a pullback here this week, 1.08 looks really interesting for some long side continuation plays. Same thing with the pound US dollar. We broke a really key level of resistance around 1.2780, and if we do pull back into that range, I'd be interested in a possible long setup. One of the key things confirming this is the top setups algorithm within the Edge Finder. You can see euro, gold, and pound. All of these things on the bullish side, because again, most of our sentiment, technical, and economic data point readings within the software tool are pointing towards bullishness for these assets. And they have been really good calls so far. I think that they could continue to be good calls going forward. I'm just waiting for technical pullbacks. Taking a look at some of the bearish readings that we have currently, dollar yen looks pretty interesting. We'll take a look at that chart now. Dollar yen pulling back here a little bit, and what we can see is that we looks like heading back to retest this key area of resistance on the daily chart. The yen looks quite strong in my perspective. Going through most of our macro data, the yen seems to be, when compared to the dollar, pretty attractive. So that would tell me to be more bearish around the 150 level. So if we go back and test that big round number, I do think that that does pose some more downside risk for the dollar against the Japanese yen. On my Sunday video, I talked at length about the S&P 500 and the NASDAQ, so I'll keep it pretty brief. I am looking on the Edge Finder for some bullish setups to form on these things. What you can see is that the NASDAQ and S&P 500 are almost bullish scores, but what we're waiting for is the technical confirmation. When we look at the trend, what we can see here is that trend for both NASDAQ and S&P 500 are getting negative scores, telling you that momentum here is bearish currently for these two indices. What I'm looking for is for that trend to flip bullish, which would change the overall score here for the Edge Finder by a factor of 4 if you think about it. If we start to see an uptrend, this number would become a +2, changing our overall score by a factor of 4 up to +7. Again, if you're confused by the way this scoring works, basically it's looking at all of the different macro data, technical, and sentiment data points that our software automatically pulls in and generating a kind of summary confluence factor score that we can see in the score or bias column. So getting constructive here on the technicals for the S&P 500, I'd be looking for a breakout, retest, breakout, retest. These types of opportunities would be chances, in my opinion, to start buying this dip. From a short-term trading perspective, I'd put stops below that and be looking for a return back to the highs. I think the risk reward looks pretty good there. On a long-term basis, I am and already have been adding shares to my long-term portfolio, as I do think that this is a great constructive buying the dip opportunity for the long term. Many people out there are reading the headlines and getting super scared and getting super bearish. We can see that in the put to call ratio. Let me show you. When we look at the put to call ratio, when this ratio goes very high, what that tells you is that the average kind of trader, the market volume is very poised to being buying. When the put to call ratio goes very high, this tells you that the demand for puts in the options market is extreme. And what that tells you is people are willing to spend a lot of money on premiums to buy puts to gain bearish speculation or protection on their existing portfolios. And when this reaches an extreme, oftentimes that ultimate fear is a great signal to get contrarian. In my experience and in my opinion, I think that this could be what is happening. So as the put to call ratio is becoming very stretched and people are paying up big bucks for premium, even a day like today where you're getting a modest bounce, people who have bought puts and calls have gotten absolutely slammed. Let me show you. So to make this point, I want to show you the Apple options chain for just a second. Even if you're not an options trader, many people trade Apple from an options perspective, and you can see Apple is actually down on the day. But if you had bought puts, right? So we've selected puts. If we buy puts here, let me show you what has happened. So the current price for Apple is like $212. And what we can see here is that if you bought like the 205 puts or the 200 puts, making a bearish bet on the price of Apple with just a few days to go, many traders out there doing this, you have lost 25% of the money that you paid towards those puts already. And again, that's just a stock that is not even the most extreme case, right? Let me show you another example. Here's Uber. This is a stock that I really like. If we take a look at Uber and we've selected puts and we've gone 4 days out, people who have been buying puts recently are down 54%, 58%, 59%, 60% on those puts that they bought. And again, the reason for this is because when the put to call ratio goes very high, puts become very expensive. When everybody's scared and everybody buys puts, put contracts get very expensive. And one day where the market's going sideways or even up causes those puts to lose dramatic amounts of value simply because you're making a big bet that the market's going to crash very quickly. And if it doesn't, you lose all your money. We've also been showing this chart quite a bit here recently. This is 3 consecutive weeks beyond 55% of market participants saying they feel bearish on this stock market. This is, to me, like I've been saying on my channel, a screaming opportunity to get contrarian in this market. We also see people very scared because the gold or the Bitcoin to gold ratio here continues to go lower, showing sentiment is very negative, very concerned. People buy Bitcoin when they're optimistic. People buy gold when they're pessimistic. That's a way to read this chart. So I like having it in the edge finder so we can keep an eye on sentiment. So when I look at the NASDAQ and the S&P 500, what I'm looking for is breakout signals that could be signaling a bottom is in. I don't think we're quite there necessarily until we see a nice break of resistance. We need to see the bulls be able to hold on to some gains. We have not been seeing that recently. So I'd like to see some gains be held by the bulls as a possible confirmation from a short-term perspective that I can get long with some conviction. I also want to talk about seasonality. Many of you guys who've been watching my videos recently know that I've been long gold. Part of the reason that going into the new year, I've been very bullish on gold was because seasonally, it's a good period of time for gold. And what you can see is that so far, seasonality has been absolutely killing it. We could see January gold had a really nice month. February was flat, but March has been phenomenal for gold. And as we go into April, I continue to trail stops and believe that we could continue to go higher because seasonality might suggest so. But that's not the only reason. Taking a look at gold's summary page within the Edge Finder, you can see we're getting a +8 score, and most of our readings here, both fundamental and sentiment-wise, are suggesting that gold continues to look bullish going forward. I wanted to show you another cool feature within the Edge Finder. You can actually look at the history of scores within the Edge Finder to do a bit of backtesting and see when readings first started. We can actually scroll back, and the first time we got a over 5 score for gold, which is considered bullish. If we zoom in right here, February 6th. Let's go take a look at when that score populated. So we said February 6th was the first time that this actually generated a bullish signal, and this is the crazy part, is it looked kind of like a high at the time, but the Edge Finder spotted bullishness from here, and what you can see is gold has actually gone nowhere but up since. And the fascinating thing about this is it just goes to show you how powerful momentum can be in markets, and when the right confirmations form within the Edge Finder, oftentimes that generates some great opportunities. Now, I'll be transparent with you, I did not actually buy gold when that happened. I waited for a little bit, missed some more of the move, and when we pulled back, I ultimately got in right around the same area and have been in that trade since. Like I said earlier, make sure to join our Edge Finder giveaway this week in the Telegram channel that's linked in the description down below. There's a free chance to win an Edge Finder copy by the end of the week. We also share within the Telegram bonus clips and content that might be useful to you, so don't miss it. Today's video is also sponsored by DNA Funded. If you haven't checked them out before, they offer profit sharing up to 90%, and they offer 1 and 2 phase challenges. You can find out all the information about them and use our special promo code linked in the description down below. Check it out, and if you're looking to get funded this year, remember my points on funded challenges. If you haven't heard me say them before, wait until you've been able to consistently produce profit before you get involved with funding programs. But if you feel that you're ready, you feel that you're prepared to actually take that next step and scale up your trading, check out DNA Funded in the link in the description down below. I know that technical charts can be mesmerizing to look at someone's charts and say, oh, I love those zones. Those zones are so perfect. But again, I would encourage you not to fall into the trap that most traders do, which is obsessing with technical analysis and treating it like it's some sort of holy grail. Technical analysis is like, it's just a lens to look at the market through, but to me, it doesn't have massive predictive power. Fundamentals help me to spot true market direction, and technicals are just red and green lights. In this case, literally red and green lights, right? I hope that makes sense. But again, like I said, one of the most common trading mistakes that I've seen is people obsess over technical analysis and they underestimate or completely rule off fundamental analysis. And I think a lot more traders would benefit. You know, one of the first things fundamental analysis will teach you, if you are new to trading, fundamental analysis, the first thing it will teach you is it will humble the absolute heck out of you when you start going down that rabbit hole. Because what's going to happen is you're going to say, okay, well, let me take a look at what CPI really means. And then you're like, oh my God, there's so much to this. And then you say, well, let's take a look at labor data. Are jobs strong in the US? And then it's just this rabbit hole of understanding the labor market data. And then you understand, well, what's the Fed going to do next? And that's just this monstrosity to understand. What fundamental analysis will do, and it's one of the most powerful things that it does for you, is it humbles the absolute heck out of you. I come to this stream like everyone else, looking to learn, because I'm never going to stop learning in the markets. There's so much to understand. There's so much to learn. And I would encourage you to embrace, you know, I know a lot of people are like, oh, just keep it so simple and just mark up your charts and trade. And I get that. And if it works for you, then don't listen to me. But most people are struggling to find consistently profitable approaches to the markets. And I think fundamental analysis offers a lens to view the markets that really are eye-opening for a lot of traders. Fundamentals are so humbling when you start realizing how complex the whole system is. You're like, whoa, I'm not a genius, and this stuff is harder than it looks. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.